A very good morning, friends. So I hope you're all doing well. And most importantly, of course, your cumulative revision on financial instruments is going on. So far we have covered a lot of things on financial instruments. And of course, there's a lot more to go as well. So what we have covered so far are perception towards Index 32. When we look at the perception of the issuer and we're looking at the presentation of the instrument on the liability side of the balance sheet, wherein we've seen a three-step model in terms of identifying, is it a financial liability? Is it an equity instrument? Is it a compound financial instrument, or is it supposed to be an hybrid instrument? And then our focus turned on. Of course, we also covered the accounting in terms of a compound financial instruments, looked into varieties of instruments from a perpetual debt instrument to an optionally convertible instrument to a partially convertible instrument, as well as a case of a compulsory convertible instrument, how the split accounting is done and how the accounting subsequently is taken care. Then we turn the focus in terms of the holder's perspective, where the holder is going to present the instrument and account it on the asset side of the balance sheet. There also we took a three-step model in terms of which we made a total of 4 charts with you. And of course, just to recall, even from the issuer perspective, I made a total of 4 charts with you. And then we also made a 3-step model and created 4 charts from the holder's point of view, that there could be 2 kinds of debt investments, FL for the issuer, CFI for the issuer, and there could be a derivative investments, or there could be what you call equity investments. We saw the various permutations, combinations in which the investments are accounted for. And we also saw from the initial to the subsequent accounting in terms of the holder perception as well, adding the element of a transaction cost as well. And then I also give you a supermind summary in terms of financial assets, how things are accounted for. Now, I've got some more special agendas to talk on you, where I would also be not talking in terms of processing fee. We've already talked in terms of TC, that is a transaction cost. And now I'm going to talk in terms of processing fee. And most importantly, another agenda where we need to discuss what we call the difference between a transaction value and a fair value. Let me do one thing. Let me, I think, just map up the concept, just a summary which can give you an idea of how your cumulative revision is happening. I'm not going to give you any details at this stage. Everything is already there with you, just in terms of how you are mapping your mind in terms of the approach towards revising and getting things embedded at the back of your mind. So let's, I think, just quickly look at a certain mind map before we take it further. So we stand at a common platform in terms of how we are looking at financial instruments. So my journey so far is being divided in terms of 2 parts, issuer and the holder perspective. So I would put it like this, that your focus in the mind as of now should be that we are focusing in terms of the issuer perspective, or we are focusing in towards the holder perspective. And when we were covering the issuer perspective, the focus is being on Ind AS 32 mainly. And the moment we've shifted to the holder's perspective, we're focusing in terms of Ind AS 109. I'm just trying to help you that you are able to consolidate the learnings at the back of the mind so that everything is crystal clear when you are going to revise the concepts. Now, when you're looking in terms of the issuer perspective, we've already seen that the instrument is classified, or you can say presented, under 4 categories. You will end up dividing the instruments into 4 categories from the presentation point of view. From the presentation perspective, we are segregating it in terms of 4 points of view. One is that it becomes an equity instrument, a financial liability, a compound financial instruments, as well as a case of a hybrid instrument. And for the purpose of taking a call that the instrument is presented as either of the four, you've already covered a three-step model. I'm not going to recall the three-step model. You already know that your focus is in terms of the three-step model which I gave you. And based on the three-step model, I've also given you a total of 4 charts as well. So once you revise things at the back of your mind, you need to be very clear that yes, my three-step model tells me the presentation of the instrument, and the 4 charts are like clarifications to the various permutation combination. I hope you've also done a mapping of the illustrations of the study material in terms of these charts. I had given you a homework that if you want that extra mileage, look at the illustrations and the study mat, map up with the illustrations and make your own mind maps as well. Then we also shifted a focus in terms of the accounting. We basically, you can say, did the accounting treatment. We learned the concept of split accounting in terms of compound financial instruments. And when I gave you a split accounting in terms of a CFI, we covered almost, I would say, 4 categories of instruments: a perpetual debt, then optionally convertible, partially convertible, and a compulsory convertible. Let's call it as debenture, though it could be a case of preference shares as well. So I gave you a connection in terms of 4 kinds of instruments where I said it could be a perpetual debt instrument. It could be a case of, you can say, partially convertible debt, or a case of compulsory convertible debt, or a case of optionally convertible debt. And then I also give you a summary chart out here as well. On this Sunday morning, I'm just trying to, recollect the learning so far that gives us a good strength in terms of things. So your mind should be very clear. Okay, what was there in the chart? What was there in the super summary chart? What are the 4 kind of instruments? What is the split accounting done, etc., etc. Then we switched over to the concept in terms of Ind AS 109. We said we have done the inputs in terms of the issuer. But let me tell you that in terms of the issuer, the financial liability accounting is pending. Equity instruments, of course, the accounting is straightforward. And I said, we're not doing any questions on that, because when you issue equity shares, you know the entry: bank debit, share capital credit, and the premium, if any, gets a credit. There is no changes in terms of the equity share capital subsequently. So we are, of course, not dealing with the equity instruments accounting, but financial instruments accounting, this FL, financial liability accounting, is still pending, because this is going to be covered in terms of 109. So I will just put it that it's covered in Ind AS 109. It's not pending otherwise, it's pending only because it's going to be covered in 109. Then comes the aspect in terms of Ind AS 109. And in this particular case, we decided the instruments again divided in terms of effectively 4 categories. So when you look at Ind AS 109, we made again a 3-step model in terms of deciding the instrument. And I said in this particular case, you can have a case of a debt investments. And this debt investments could be something which is either FL or a CFI from the issuer point of view. But for the holder, of course, it becomes a debt investment. So this makes it 2. And then we've got something which is called equity investments. And then there is something which we call as a derivative investments. So in this particular case also, I gave you a total of a 3-step model with a total of 4 charts again. See the mapping. I have intentionally created those 3-step models and 4 charts so that everything becomes very clear at the back of the mind. So in this particular case, what we did, in order to decide the category of this, we again covered a 3-step model out here. And in terms of the 3-step model, I also then gave you a total of 4 charts here as well, giving you clarifications on the 3-step model. And of course, we did questions on each and every category. I would say we did a total of 5 cases with you. When I did the accounting of the financial asset, so in terms of the accounting for financial asset, I covered a total of 5 cases with you. And in this particular case, the 5 cases, we covered the case of a debt investments, which was accounted at amortized cost, which was accounted at FVTOCI, which is always an R, and we covered the concept of FVTPL. So we did these 3 cases in terms of a debt investments, and I also covered equity investments as well. And in terms of equity investments, we've got 2 categories, FVTOCI, which is always a case of NR for equity investments, and an FVTPL as well. And along with this, I also covered the aspect of transaction cost, where I gave you a summary chart as well. So even in this particular case, I added the element of a summary chart. After doing all these things, I also gave you a super summary chart here as well, laying down the nitty-gritties in terms of things. So of course, there were fillers in between, and those fillers were concentrating on understanding the different measurement base, etc. But that was all a concept which was related in terms of explaining a 3-step model. So now you can see the complete mapping which should be there at the map of the mind. So this is, I would say, the mind map which is so far. This is what the mind map we've created so far the journey has been. Now, moving forward, what's more awaiting for you? As I said, we're going to add some more masalas out here. So now what is coming to my mind is I want to now add special issues. When I'm looking at the accounting of a financial asset, when I'm looking at the accounting of a financial asset, there are certain special issues which are coming at the back of the mind. The first special issue is the transaction cost, and that we've already seen. I put that in the summary chart as well. The TC is something which is supposed to be added to the financial asset on initial recognition, except FVTPL. Now, the another special issue which we need to tackle is the case of a processing fee, which generally is there in terms of loans. When we talk in terms of bank loans, the banks would, charge you a processing fee. So a little similar kind of a treatment which follows a TC, we need to see the concept of processing fees as well. And most importantly, we need to see that if there is a difference between a transaction value and a fair value. This is what we need to dock in detail. Because many times questions are coming in the exams where they test your knowledge in terms of the difference in a transaction value and a fair value. If you remember earlier also, I had given you that financial assets are initially always taken at a fair value. Now, when you enter into a financial asset investment, you are paying some money, which is a transaction value. But the initial measurement is going to take place at a fair value. So if there is a difference between a transaction value and a fair value, how is that accounted for? So I've got 2 focus points now to go with you. One is the processing fee discussion, and one is the difference between a transaction value and a fair value. But before that, I am also going to do, as I promised yesterday, questions which are there in the RTP, which is an element of Ind AS 21 clubbed with Ind AS 109. So as a special inputs in between, what I'm adding, let me add this in red color. So I'm also adding, a special kind of a question, which came in the RTPs as well. And this is a blend in terms of Ind AS 21 coupled with Ind AS 109. So before I'm going to take you to the concept of processing fee, and before I take you to the concept of transaction value and a fair value, a little special question for you, which is based on Ind AS 21 and 109. So far, whatever your learning on 109 has been, and your understanding on Ind AS 21 basic concept, we've got 2 questions which came in the RTPs. I hope this summary helps, It gives you a fair idea of where do we stand as of today. Now, don't ask me where the journey is going to go forward. There's a lot more to go. That mapping, of course, I'm going to give you as we progress further. This is so far, right? So this is a quick summary which I wanted to give you. So now I think let's do one thing. let me just take you to an interesting question. There was a question which came in RTP, that is May 2020. So this was a question which came in RTP in May 2020, and I am now interested in doing this question as a part of the warm-up exercise. Let's, I think, read the question. So it says on 1st April X1, M raised a long-term loan from foreign investors. Now, when you say that you raised a long-term loan, one thing is very clear, that we're looking at things from the issuer point of view. Though let me tell you, we have not done the accounting of financial liability specifically. So I just want to caution you, we have not done the accounting for financial liability, but nevertheless, it is a mirror image of financial asset at AC. So don't get worried. Because even in terms of compound financial instruments, you've already done the accounting of the financial liability element. And trust me, the accounting of financial liability is exactly done the way you account FL at AC, which is in the CFI. Absolutely same. Though we will discuss the financial liability concept separately. So it says on 1st April, M raised a long-term loan from foreign investors, and the investors subscribed for 6 million foreign currency loan notes at a par. It says it incurred an incremental issue cost of 2 lakh foreign currency unit, which is nothing but supposed to be a transaction cost. Interest of 6 lakh is payable annually on 31st March, starting at the end of the first year, March X2. The loan is repayable on March X7 at a premium, So the moment you look at a premium, what should come into the mind is, I also told you, if you remember the concept of AC, you look at a discount on issue, Ghanti Baji. You look at a premium on redemption, Ghanti Baji. You look at a TC, Ghanti Baji. Sir, which Ghanti? The bell which should ring is the EIR. So when you look at the presence of a TC and when you look at the presence of the premium on redemption in this case, it should immediately trigger your mind that I would need an effective interest rate. And in the question, we are already given the effective annual interest rate is supposed to be 12%. So the EIR is already given to me at the rate of 12%. The appropriate measurement basis for the loan is amortized cost. So we're already given the measurement base as well. And then we are given the exchange rates at the beginning, exchange rates at the end, and the average rate of exchange for the year. And then it says the functional currency of the group is supposed to be Indian rupee. So which is the inputs given to me as per Index 21. So if your functional currency is supposed to be Indian rupee, you need to convert this all in terms of Indian rupee. And then it says what would be the appropriate accounting treatment for the foreign currency loan in the books of M Limited for the year X1, X2. M Limited, we have already seen, is supposed to be the issuer. So we're looking at the perception of the issuer. And then it says calculate the initial measurement of the loan, calculate the finance cost for the year and the closing balance and even the exchange gain or loss. So a couple of things asked in the question. I think it's a good question. Testing your understanding on Index 109, financial liability accounting, blending it with the concept of Index 21. Do you know which items are converted at which rate? Good question, brilliant question. So let me do one thing. I am now going to solve this particular question as well. So let me do one thing. Well, I always believe, when you're doing a question in terms of financial instruments, I think the best way is always make a ledger account. It gives you a track of things, of how things are done. Now, I would also give a suggestion that once you are doing a question which is a blend of 21 and 109, it is better to make 2 columns in the ledger. One column which will concentrate on the foreign currency and one column which will concentrate in a functional currency. Let's see how. So I'm just going to create a ledger account for the purpose of accounting. And I am going to consider two columns. One is for the foreign currency and one is for the functional currency, so that we can clearly see the track in terms of recording. So in this particular case, I am putting foreign currency as one column and I'm putting the functional currency as another column. Here also on the credit side, the foreign currency, and I'm putting the functional currency that is on the credit side. So this is my financial liability, which is being taken at amortized cost. Since we are looking at the accounting from the point of view of the issuer, our focus is FVTOCI. And as I said, just make this ledger the way you make FL for a CFI. There's nothing different at all. Okay, so now let me have a look further on this. So let's go back to the question and let's pick up the data. So first, what I'm going to do, let's even forget about the fact that there is any kind of foreign currency. Just make the ledger account the way a normal ledger account would be made. So let's begin. It says on 1st April, you raised a long-term loan, which is for 6 million, that is 60 lakh currency units. And it incurred an incremental cost of 2 lakh. Now, one thing which we need to keep in mind. In terms of the financial asset, the TC was added to the initial recognition. In terms of FL, it is going to be reduced. And there is no big rocket science in terms of why we are doing a reduction. Just look at the entry. Just imagine the entry. When you raise funds, you would put an entry bank debit, FL credit. The focus is bank debit. When you incur a TC, it is TC debit and bank credit. So I'll put it like this. So when you raise the money, the entry is bank gets a debit and FL gets a credit. Now, when you go to incur a TC, you can say instead of TC, you can say financial liability debit and the bank gets a credit. This is on account of TC. So the logic is now fairly simple, that if you are looking in terms of the treatment of TC, what you need to do in this particular case is as simple as that. The financial liability, which is a credit, is getting a debit because of TC. So which means that at the time of initial recognition, you need to consider the liability at fair value minus the TC. Simple mathematical logic. Okay, so what do we need to do in this particular case? When you are considering the inputs in terms of FA, you need to add a TC. FL, you need to reduce a TC. And the logic is when you raise the money, FL gets a credit. And when you are going to incur a TC, the FL gets a debit. So indirectly, it is getting netted off. So what we're going to do, on the 1st of April, I guess let me just go back to the dates once again. So we can say on 1st April X1, 60 lakhs was raised and 2 lakhs is supposed to be the TC. So we put the entry on 1st April X1. You're raising the money, so the entry becomes bank gets a debit. And this is going to be 60 lakhs of currency units minus the TC of 2 lakh. So this works out at 58 lakhs is the amount in foreign currency in this case. Great. Now let's go back and see more data. Then it says the loan is repayable. Sorry, the interest is payable annually on 31st March, 6 lakh. And the redemption will take place at a premium, which I'm not concerned at the moment, but the EIR is 12%. So what we're going to do, we are going to consider at the end of the year, we're going to consider the finance charge, and this finance charge will be taken at the rate of 12%. Because when you're going to unwind the interest, or you can say you're going to accrue the interest, it's going to be at the EIR rate itself. So on 58 lakhs, we take a 12%, that works out at 6.96 lakhs is the finance charge. And at the end of the year, you paid the coupon rate, which is given 6 lakhs. So we put the entry on 31st March X2. We made a payment which is to the extent of 6 lakh foreign currency units. Now, one thing very clear in this particular case, we are given that we are following AC. That means I'm not concerned with any fair value changes. So I can conveniently consider the balance CD as a balancing figure. So on 31st March X2, we can take a balance CD as a balancing figure. So let's see what is the balancing figure.
58 lakh 96,000.
Wonderful indeed. 58,96,000 is the balance CD. And if you notice something at this particular stage, I have not even considered any impact of foreign currency. We just made the ledger account a normal way, ignoring that there is any foreign currency for that matter. Now what I'm going to do, I'm going to create the second column where I'm going to translate the impact in terms of Index 21. Then I just need to consider which items are converted at which rates. Let's go back to the question. Now comes the role of the last para of the question. The relevant exchange rates at the beginning, one foreign currency 2.5, closing 2.75, average is 2.42. So we just need to now see which items are going to be converted at which rate. The opening balance, of course, the opening rate. The closing balance, of course, the closing rate. The payments which are made at the end of the year, again at a closing rate. And the interest is a P&L item that's going to be taken at an average rate. As simple as that. So we're going to translate this item at the opening rate. This will be translated at the average rate. And this is a payment made at the end of the year, so taken at a closing rate. And this is again at a closing rate. So let's see what are the rate of exchange. The opening is 2.5. So the opening is 2.5 and the closing is 2.75. And I think the average was 2.42 if I rightly remember. That's right. And that's it. We're done. So once we're going to convert all these amounts in terms of foreign currency, the ledger account will have a difference. And what would that difference indicate? It's a foreign exchange gain or loss. And that foreign exchange gain or loss is going to be captured in terms of what? Is this financial liability a monetary item? Yes. And if it is a monetary item, then differences will be taken in which place? Profit and loss. So let's convert this. 58 into 2.5 is 145 lakhs. 6.96 into 2.42 gets converted in 16.8432 lakhs. Then 6 into 2.75, that comes to 16.5 lakhs. And this works out at 162.14. Yes, that's right. Now let's see what is the balancing figure in this ledger. And that would represent the foreign exchange gain or loss.
6.79.
Debit side, but a credit side?
Credit side.
Okay, so I think it's coming to 16.7968 if I'm right.
Yes, sir.
Great. So this is the balancing figure. This is going to be the foreign exchange loss, and that foreign exchange loss will be taken in the profit and loss. That was the application in terms of Index 21, applying the conversion rates, beginning, opening, closing rates. Just remember, the P&L item is at the average rate, but the payments are made at the end of the year. So that's again at a closing rate. Wonderful question indeed. This was a blend in terms of Index 21 and 109, though the focus was on a financial liability. But trust me, if I were to make this kind of a ledger with reference to a financial asset, it would be more or less a mirror image. Except the fact that when you're going to consider initial recognition, it'll be 62 lakh because you're going to add the TC in that particular case. Superb. Okay, so now I think let's do another question with you. So after the May 20 RTP, there was another interesting question which came in November RTP as well. So this is again a blend in terms of 109 and the blend of Index 21. So earlier they gave the concept of AC And then they give the concept in terms of OCI. Lovely. Let's read the question. It says an Indian entity whose functional currency is rupees. It says it purchases, that means the focus is now on the holder's point of view. It purchases USD denominated bonds at a fair value of $1,000. The bond carries a stated rate, which is a contracted rate on its face value. The interest is received at the year end. The bond has got a maturity period of 5 years and is redeemable at its face value, which is $1,250. And then it says the fair value of the bond at the end of the first year is 1060. The exchange rate on the date of transaction and at the year end is given, and a weighted average exchange rate is also given. So we are given the exchange rates at the end of the first year, the average and transaction dates. So this is all the information which is given with reference to Ind AS 21. Then he says the entity has determined that it's holding the bond as a part of the investment portfolio whose objective is met both by holding the asset to collect contractual cash flows and it says selling the asset. Now, in this particular case, we're already given in the next sentence the category as well. But trust me, the category as such was not required. If you remember the three-step model, that in this particular case, there is a business model which is given to collect as well as to sell the asset. So can you tell me which category should apply in this case? The business model is supposed to be collections as well as sale of the asset. It's a mixed model in terms of a business model. So accounting based on what? That's wonderful indeed, OCI. That's right, absolutely. So we are going to consider FVTOCI, and this is a case of a debt, so it's going to be recycling. Then he very clearly also tells you that it is classified under FVTOCI category, and we know that debt investments is always with R. Then he says the bond results in an effective interest rate of 10%, so the EIR is also already given. You are required to calculate the gain or loss to be recognized in the profit and loss and in the other comprehensive income for year one, and also pass a journal entry as well. Wow. So here again, the focus is in terms of accounting for OCI category. Now your mind should start working. The difference between the OCI and the AC is what? In terms of AC, you don't capture the fair value change. But in terms of OCI, you capture the fair value change. But in both the categories, the concept of EIR is applicable. So what we're going to do? We're going to make a ledger accounts in two parts. We'll make one column for a foreign currency, another one for a functional currency. We'll take care of the exchange rates later. First, let's make the ledger account as if there is no foreign currency involved. Let's begin the picture. Now we are looking in terms of the financial asset in this case. So let's make a ledger account. I would say the best advisable thing is whenever you confront a question which is a blend in terms of financial instruments and a foreign currency, it is always good to do the questions in two columns. First, when you make the column in a foreign currency, just concentrate on a 109 concept. And then you can translate that in terms of Ind AS 21, so you'll never go wrong. So let's create two columns again on the debit side and two columns on the credit side as well. So here the focus is a financial asset which is supposed to be a debt investments, and this is being accounted at FVTOCI, that is recycling. So this is the figure. So we're taking the foreign currency and we're going to take the functional currency. Similarly, on the credit side, we take the foreign currency and we're going to take the functional currency as well. So let us now focus on the foreign currency to begin with. Okay, so let's go back to the details in the question and let's see the data which is given without the impact of the currency right now. It says the entity whose functional currency is rupees purchases a bond at a fair value of $1,000. Is there any TC which is given? I don't see. The bond carries a stated interest rate of 4.7% on the face value. And by the way, the face value in this case is not 1,000. The face value is 1,250. So that's another thing we need to be careful. Because generally the face value is 100 or 1,000, but in this case it is 1,250. So let's first record the inputs. So we will record this as bank. We initially made a purchase at a fair value which is 1,000. And this was on a particular date. I guess the date is not really given at the beginning of the year. So there is a coupon rate of 4.7, but there is an effective rate which is given, and the effective rate of interest is 10%. So let's see what is the finance income at the rate of 10%. So this is going to be 100. And we're going to receive the money at the end of the year on the face value, which is at the stated interest rate, which is the contracted rate at 4.7%. So on the face value 1250, we get 4.7%. That's, I think, 58.75. Right, so I've taken care of the opening balance. I've taken care of the interest which is accrued. I guess let me just round it off also to 59 maybe. Just round it off to 59. This is the status. Now tell me, the balancing figure is going to be taken as the balance CD, or are you going to consider the balance CD at a fair value? This is not AC, this is FVTOCI. So the balance CD is going to be taken as a fair value. So let's see what is the fair value at the end. So we given the fair value at the end of the year is 1060. So we take the balancing figure 1060. Where do I consider now the balancing figure in this ledger? We still not applied 21. We're simply applying the concept of 109. If it is a case of FVTOCI, any balancing figure is the fair value changes which will be taken in OCI. Let's see the balancing figure. I guess we're getting a balancing figure 19 on the debit side, I guess. So this is going to be a foreign exchange gain, and this foreign exchange gain is again going to be taken in the P&L, because this investment, I would say again, is supposed to be a monetary item, and in this particular case, any exchange gain arising on a restatement is going to enter in the P&L. Okay, now I think it's time to convert this entire thing in terms of the foreign currency. So we need to again apply the exchange rates which are given in the case. So first of all, when you made the initial investment, we're going to consider the opening rate. When we consider the finance income, it's going to be at the average rate. The foreign exchange gain is arising at the year end, so we're going to take a closing rate. The interest which is received at the end of the year, so again a closing rate. And the balance CD is again at the year end, so we're going to consider a closing rate as well. So let's pick up the exchange rates. The rate of exchange on the date of transaction is 40, year end is 45, and average is 42. So the rate of exchange at the beginning is 40, average is 42, and the closing is 45. So let's multiply this with the respective exchange rates and then see the balance. So this is going to be 40,000 and this is going to be 4,200 and this is going to be 855, I guess. And then this is 59 into 45, that's 2655. And this is going to be 47,700 is the balancing figure. Now let's see, the closing balance. USD 19 is fair value exchange. Yes, that is the foreign exchange gain which we are getting enters in the P&L. That's right. Sorry. Oh, my mistake. My mistake. Yes, you're right. It is not the foreign exchange gain. Sorry, my mistake. This is a fair value change, and this fair value change is supposed to be entering in the other comprehensive income. My error. Thanks for the correction. Because right now I'm not yet converted in terms of Index 21. Okay, that's great. Now let's see what is the balancing figure in this particular ledger. That would be the foreign currency gain or loss. Is it coming to 5,300 on the debit side, I guess?
Yes,
So
sir.
we're getting a balancing figure 5,300, which is the foreign exchange gain. And this foreign exchange gain, of course, is going to be entered in the profit and loss. Wow. So I think this takes care of the inputs in terms of a blend. So one, we have seen issuer point of view, 21,109. One, we've seen holders perspective, that is 109 and 21. Good questions indeed. I think both the questions are pretty good in nature. Right, so far so good. I guess everybody is pretty clear with the confunda, right? Okay, so this was a warm-up exercise. Now I'm going to go on to the next agenda with you. Having done the special issue of blending Index 21 and 109, I'm now going to come to the concept of processing fee. So let me take the journey on the processing fees now. At this stage, I would also like to, just keep in mind the concept of TC. Because when you're looking at a TC from the issuer point of view and from the holder's point of view, you've seen the treatments are different. Now, I also want to consider the concept of processing fee from the issuer and the holder's point of view so that there is no confusion which comes in. So let's do one thing. We are going to first conceptually have a look at both the TC and the concept of processing fee from the issuer as well as from the holder's point of view. Now watch this carefully. So I am first of all looking at the entries which we're passing in terms of TC or in terms of processing fee. So my perception is issuer and my perception is holder. And I am looking in terms of TC as well as the concept of a processing fee. And then we can make some conclusions based on this. Now, what is a processing fee? Generally, when you take a loan from the bank, in those particular cases, the bank would charge you a processing fee. Like, for example, when you take a loan, they may take around, let's say, 1%, 0.5%, whatever, as an initial processing fee of the loan. So which means that on one hand, you are taking money from the bank, but on the other hand, you're also paying money to the bank. In the earlier accounting, which is there in terms of ICAI, the processing fees used to be credited to the P&L immediately. But then in this particular case, the concept in terms of 109 is why should it be taken as income at time zero? It should be technically spread over a period of time. And if it needs to be spread over a period of time, it needs to be incorporated in the concept of an effective interest rate. Aha! Does this mean that if there is a TC, it triggers an EIR? Yes. And even if there is a processing fees, it would also trigger the concept of EIR? Yes. So remember, now I'm adding a fourth item in terms of triggering an EIR concept. So which means that if I am given a TC, it triggers EIR. If I'm given a processing fees, it triggers an EIR. If there is a premium on redemption or if there is a discount on issue, any of these items seen is going to trigger the EIR. My focus is on a debt investments, whether at AC or OCI. So what is to be kept in mind is number one, when you see a TC or when you see a processing fee, the immediate thought process which should come to your mind is that it should trigger the computation of EIR immediately. We need to calculate the EIR in these cases. The concept process in terms of 109 was very clear at the mind that a transaction cost cannot be expensed immediately. It needs to be spread over the life of the instrument. A processing fees cannot be considered as an income for the banker, or it cannot be considered as an expense from the person who took the loan. It needs to be spread over a period of time. And if it needs to be spread over a period of time, it needs to be incorporated as a part of the EIR. So the moral of the story, which I would also like to mention at this particular stage. So I would say EIR triggers under 4 circumstances. We've added the 4th input in this particular case. The moment you do a question and you identify that there is a TC, or there is a processing fee, or there is a discount at the time of issue, or there is a premium on redemption, you should immediately reach the conclusion. You should immediately reach the conclusion that I would need an effective interest rate. That's one thing which should immediately click your mind. Now let's see the inputs in terms of the treatments from the holder and the issuer perspective. Coming back to the point. If you look at an issuer, when he raises money, he puts the entry, bank gets a debit and financial liability gets a credit. And when he incurs a TC, then in that case, the financial liability will be given a debit and the bank gets a credit in this case. So if you look at the net treatment in this case, so do we need to write off the fair value changes account at the time of settlement, the new EIR? You're talking about the foreign currency part? No, the foreign currency gain or loss is going to be taken in the P&L on an immediate basis. It's a restatement gain or loss, no deferments. Okay, so now coming back to the picture in this particular case, when you are considering the TC, the financial liability got a credit and it got a debit, which means you need to consider fair value minus TC as a part of the initial recognition. So when it comes to a TC from the issuer point of view, you need to consider net of TC. Now, from the holder's perspective, the entry is financial asset gets a debit and the bank gets a credit. And when you incur a TC, the financial asset, which is the TC, gets a debit and the bank gets a credit. I'm just trying to give you a logic in terms of why it is added or why it is reduced. Now, in this particular case, we can clearly notice that the financial asset is getting a debit and for the TC also it is getting a debit. So the initial recognition will be fair value plus a TC. Of course, this concept is not applicable to FVTPL. This is applicable to all categories except FVTPL. So when you're doing this particular treatment, it is applicable. It is applicable in all cases except. It is applicable in all cases except FVTPL. So this does not apply in terms of an FVTPL because in FVTPL, the TC is immediately expensed in the P&L, whether it is issuer or whether it is a holder's perspective. So this treatment will follow when you are considering, you can say AC or an OCI category. Though in terms of FL, there is no OCI, it is either AC or FVTPL. But in terms of a financial asset, AC yes, OCI yes, FVTPL no. Okay, now let's come to the input in terms of the processing fee. Now let's look at the issuer point of view. And in this case, we are looking at the person who took the bank loan. Holder is the banker itself. So what would the banker do when it gives you a loan? It would say the financial asset loan gets a debit and they are giving you money. So the bank gets a credit. And when they receive a processing fee, they'll put an entry, bank gets a debit. FA is going to be given a credit for the processing fees they receive. So when the bankers will give you a loan and they would take a processing fees from you, so when they give you the money, they create a loan, which is a financial asset. And when they receive the processing fee, they will reduce the financial asset. So what is the treatment in terms of this? We can say the financial asset is getting a debit and a credit. So the initial recognition is the fair value minus the processing fee from the holder's perspective. Now see the contrast. In this case, it is a plus, but in this case, it is a minus. Now let's see the person who took the loan. The person who took the loan, he would put the entry, in this case, bank gets a debit, and the financial liability, the loan gets a credit at this stage. And when he pays the processing fee, the financial liability will be given a debit for the processing fee paid, and the bank gets a credit at this stage. Which means if I now look at the entry, the financial liability got a credit and the financial liability got a debit. So the initial recognition will be fair value minus the processing fee. And that's where people tend to get confused at times. They believe that there is going to be a reverse treatment in the books of issuer and holders. So watch this carefully. In terms of TC, we add the TC, but issuer, we subtract the TC. But in terms of the processing fee, it's going to be reduced in both the books of accounts. The person who pays the processing fee also takes a reduction. The person who receives the processing fee also takes a reduction. So remember, for a TC, there is an opposite treatment, but in terms of a processing fee, it is a common treatment. There is going to be a reduction in the processing fee from the holder as well as from the issuer point of view. And of course, I've already said, the presence of the processing fee and the presence of a TC would trigger the need of calculating an EIR as well. I hope, friends, you got the point very clear. So, moral of the story. So if you now tell me in the special issue number 2, what is the treatment of a processing fee, I would say, irrespective you tell me issuer, irrespective you tell me holder, number 1, you need to make a reduction in terms of the processing fee at initial recognition. And immediately there is a need to calculate the new EIR as well. Now, there is a very interesting question which is given in the study material, which I am now going to take you forward. So let's have a look at a question which is there in the study material related to this. This is unit number 2. There is an illustration number 20. So let's have a look at the illustration number 20, which is in the unit number 2. So let me just read the question. Now, in this particular case, the accounting only at the initial recognition is done. Do you want me to take the inputs further and give you the subsequent accounting as well? Let me know if you want more details on this, though it could involve a lot of calculations as well. Let's read. You can give your inputs in the meantime. So we are given the inputs. ABC, a bank, gave a loan to a customer. So naturally, the bank in this particular case is going to call this as a financial asset. For the ABC bank, it is a financial asset. It says they gave it loan to Target Limited. So we can say for Target Limited, it becomes a financial liability. It says it carries a fixed interest rate at the rate of 10% for a period of 5 years and a 12% for a period of 3 years. Now, there are basically 2 loans which the company has taken. They've taken a loan at the rate of 10% for a 5-year loan and 12% for a 3-year loan. Additionally, the bank charges a processing fees as well, which is 1% of the principal amount. So I know that this processing fee, irrespective, is seen from the point of view of the bank or is seen from the point of view of Target. It's going to be a reduction at initial recognition. Target Limited borrowed the loans as follows. So we are given what is the money borrowed for the 2-term loans. Compute the fair value upon the initial recognition of the loan in the books of Target Limited. That means the focus is on the financial liability. And how will the processing fees be accounted for? Now, at this stage, let me now also tell you something. In this particular case, unless mentioned otherwise, we'll always assume that the transaction value and the fair value, of course, is the same. So in this particular case, when it says that you borrowed this loan, we are saying that this is the fair value itself. But when he says calculate a fair value, we are indirectly saying that we need fair value minus the processing fee. This is the amount which is to be taken for the initial recognition. So I think if somebody asks me what is the amount at initial recognition, I will consider the loan value minus the processing fee done. But what do we need to do in terms of the subsequent accounting? Can I say, do I see any TC in the question? No. Do I see any premium or discounts in the question? No. But do I see a processing fee? Yes. Does it trigger an EIR? Yes. So am I given an EIR in this particular question? No. So am I supposed to calculate a new EIR for subsequent accounting? Yes. What do you want me to do? Do the accounting at initial recognition, or you want to look at the calculations of the EIR and look at the subsequent accounting as well? Okay, I think somebody said a yes on that, but you said a no or a yes. I don't know whether it was a yes or a no on that. So let me, I think, first make a walkthrough on the initial recognition, then we can see the inputs. So in this particular case, I guess you can keep reading the inputs. I am directly going to take you to the net answer out here. So if I were to look at how the things will look like, this is the net resultant which is given. So we are given the fair value of the 5-year loan. This is the loan value minus the processing fee. This is initial recognition. The fair value for a 3-year loan, this is the transaction value minus the processing fee. And now the effective interest rate shall be higher than the interest rate of 10 and 12%. But of course, the computations have not been done. I think I didn't get any inputs on that. I presume I don't need to calculate the EIR to you. Because in this particular case, if you need to calculate in EIR, you need to basically calculate an internal rate of return from the point of view of the investor, organize the data and get the results. If you want, I can do it for one loan, but of course not for the 2 loans. Any inputs on that? So it says the EIR shall be higher than 10 and 12% so that the processing fee gets recognized as an interest over the respective term loans. Basically, in terms of TC and in terms of processing fee, when you incorporate them as a part of the EIR, you can say indirectly they are getting deferred and recognized over the period of the instrument. So irrespective, you say it's a processing fee, or irrespective, you say it is a TC, the idea is that it should not get expensed immediately, but get spread over the period, and it is in the form of, you can say, enhanced or lowered interest rates as the case may be. So the calculation is same as the case when the TC is present? Yes. So what are you going to do in this particular case? Let me just give you some basic idea without getting into nitty-gritties. So in this particular case, just to give you a little inputs, how you would calculate the EIR, let's take one particular case. So if I am looking at the calculation of the effective interest rate, think from the investor's point of view. If you think from the investor's point of view, that is from the banker's perspective, you can say, the issuer point of view. So let's think of, the cash outflow. So we can say, as a banker, what is my cash outflow? I give a loan, but then I get a processing fees as well. So if I consider the first loan, we can say 10 lakhs minus 1 lakh, 10,000. So we can say 9,90,000. This is the outflow, fair value minus the processing fee. And then you organize the cash inflow, which is in the form of interest, which you will get for the next 5 years. And at the end of 5th year, you're going to get the principal money back as well. So what you need to do in this particular case now, calculate the internal rate of return. Organize the input. What is the discounting rate at which the present value of inflows equals 990? So in this particular case, you do the same calculations. You need to consider what is the discounting rate at which the present value equals this. So get that discounting rate at which the present value of inflow equals this is the internal rate of return, or this becomes the effective interest rate. So one thing is pretty clear on a mathematical front. In this particular case, if you are considering any IR, what you've done, you basically reduce the outflow. With the reduced outflow, naturally, the internal rate of return will go up. And that's why it said that the effective interest rate is going to be more than the coupon rate of interest in this case. So once you get the new EIR, then you need to do the accounting in a normal way. I think it is manageable, right? Clear. Wonderful indeed. So this was on the processing fees part. Okay, now we are going to come, friends, to the third agenda. I am now done with the concept of TC. I am now done with the concept of processing fee. And now comes the main agenda, and that is difference in terms of a transaction value and the difference in terms of fair value. Now you'll see suddenly the level moving up, because I am now going to blend my discussions with reference to Ind AS 113. Ind AS 113 talks in terms of fair value measurements. I think you have a knowledge on the fair value measurements. Can I safely presume you know what is observable, unobservable data as per 113, correct? Great. So let me now take you further. And there is a very interesting chart which is given in the study material in the unit number 2. We are now going to have a look at this interesting chart. Now please hear me carefully, because I'm going to create a lot of permutation combinations in terms of this particular area. Now my area of discussion is a difference between a transaction value and a fair value. Sir, but what is a transaction value and what is supposed to be a fair value? Let's give you an example. Let's, I think, first understand this particular bit as well. Oh my God, what happened suddenly? Technical things at times, creates a little problem as well. When I speak a little technical things, technicalities gets disturbed. Just give me a second on that. Right, so let me just come back to the position. So in this particular case, my focus is now in terms of the special agenda 3, transaction value and a fair value. Now let's understand this bit wonderfully first and then move ahead. So we're looking at the issue of transaction value versus the concept of a fair value. So we're looking at the difference between a transaction value and a fair value. When I was learning IFRS, because Ind AS is nothing but you can say a converged IFRS. So when I was looking at IFRS for the first time, this journey started almost like 2006, 2007. At that particular stage, I was very surprised at one particular concept. And I think I'd like to remind you that when I discuss this particular concept. We were in school and we were in college, and even when I did my CA, of course, I did my CA when there was nothing called Indian Accounting Standards. We just had accounting standards at that time. So, whenever we were given an entry in school, college as well, like for example, if you've taken, for example, you make an investment. So let's say, for example, if you make some investment, then what is the entry? So we used to say that let's put the entry investment gets a debit and bank gets a credit. And if you made an investment of, let's say, 1 lakh, you put the entry at 1 lakh. And if, let's say, for example, you borrow money, then the entry in this case is bank gets a debit and the loan in this particular case gets a credit. So let's say if you've taken a loan of 1 lakh rupee, so you put the entry that is 1 lakh. We never realized one thing, and until somebody tells you, we didn't even realize this, because we were told in school and college that when you put the entry, the debit and the credits is always same. Because we said that if you put the entry bank debit and loan credit, the entry for the debits and credits is same. And even when you say you made an investment, the entry is debits and credits is same. Later did I realized in terms of IFRS that when you look at a liability, if I took a loan of 1 lakh rupee, what is my liability? Is that 1 lakh my liability? No. My liability is what I am going to pay in the future and discounted to the time value of money. So when I have taken a loan of 1 lakh rupee, that 1 lakh rupee is what I get. But my liability is not what I get. My liability is what I'm going to pay. So in this particular case, I realized in terms of IFRS and now the Ind AS that when you put the entry on the debit side of bank, you are saying what we receive. And when you're looking at the loan on the credit side, you need to consider what you will pay. So a person would think that what is the difference between what you receive and pay? When you say that you received this money, you received that 1 lakh rupee, the value at which you entered the transaction. You received that 1 lakh rupee, that is the amount which you entered the transaction. So this amount is going to be recorded at what is called a transaction value. That is the value at which you entered into the transaction, and that is called a transaction value. But when you consider what you're going to pay, you will pay in the future. So you will take a present value of all the future cash outflows. And when you consider the present value of all the future cash outflows, then this can be technically called as a fair value. I think let me put the concept once again. Our traditional accounting is always been that if you take a loan of 1 lakh, bank debit 1 lakh, loan credit 1 lakh, but that's not the case. Because when you put the entry bank account debit, bank is going to be with the amount you received, and which is the amount at which you entered the transaction, which is called a transaction value. And when you consider the amount of loan, in this case, the loan is what you're going to pay. And you're going to pay in the future. So you need to consider the present value of the future outflows. And that is called a fair value. So this is the debit side with the transaction value and the credit side with the fair value. So but even if you consider the present value of all the future outflows, is that not going to be equal to the principal amount of the loan? Maybe, maybe not. So it is not necessary that the fair value is going to be equal to the transaction value. So Ind AS 113 along with Ind AS 109 tells you, rather I would say 113 gives you the main guidance that if there is a difference between a transaction value and a fair value, what do you do? Because all financial liabilities and all financial assets are initially recorded at a fair value. The same logic also goes in terms of the investments as well. Now, in this particular case, when you invested 1 lakh rupee, so I would say that bank is given a credit with what you pay today. I invested 1 lakh rupee, so I transacted at a value of 1 lakh. So bank gets recorded with, you can say, the transaction value, what you paid today. But when you say investment, investment is with the amount which you will receive in the future. So this is what you paid today, and this is what you're going to receive in the future. So when you say that what you're going to receive in the future, you will get interest, you will get the contractual cash flows in the future. So you need to consider, you can say, the present value of all the future cash inflows, and this is what is going to be called as a fair value. So there is going to be a difference in terms of a transaction value and a fair value maybe. So I understood one very important inputs in terms of the Ind AS, that when you are recording the financial assets or when you are recording the financial liabilities, the financial assets and liabilities are recorded at a fair value. But the corresponding bank, which is a debit or credit, is the transaction value. So for example, as I said, when you invest, you give a credit to the bank with what you paid today, transaction value. But the investment, the financial asset, gets a debit with what you're going to receive tomorrow, which is the present value of future inflow, fair value. And similarly, for a liability, you debit the bank with what you get today. This is what you are going to receive today. And when you say the loan gets a credit, this is what you're going to pay in the future. So the present value of the outflows, and that is a fair value. So we understood that the debit and the credit side of the entry is not the same amount. The bank is recorded with a transaction value, and the asset or liability is recorded at a fair value. So there could be a difference in terms of the transaction value and the fair value. So if there is a difference in this entry, where are you going to put the difference? That is the focus area of discussion. That in terms of asset or in terms of liability, when there is going to be a difference in the transaction value and the fair value, where are you going to put the difference as? Now, the focus in terms of discussions is going to be more on the assets part. Even if you look at the questions in the study material, the questions are concentrating in terms of differences which are arising on account of financial assets. So in my course of discussion, when I compare the transaction and the fair value, I am going to consider the focus on the financial assets. I hope I made sense on the inputs of discussion. That is the agenda number 3. Now I think let's come back to the chart which is given on the issue number 3. So I'm calling this as the special issue 3. This is what we're calling as the special number 3, which is a difference between a transaction value and a fair value. What is to be done if there is a difference in the transaction and the fair value? Now hear me carefully. The next couple of minutes is going to be crucial. And I will first create a chain of thought in the next 5-10 minutes, and then we're going to make walkthrough. We're going to do illustrations on each and every permutation combinations as well. Let's watch this. It says very clearly that there is an initial measurement. We're looking at typically the initial measurement of a financial asset, which is going to be done at a fair value. That's what I said earlier, that when you are considering the initial measurement of a financial assets, it's always at a fair value, except a trade receivable and a loan recoverable on demand. It says you need to see that the instrument is at market terms or the instrument is at off market terms. So I would say step number 1. I am also going to convert this in terms of a 3-step model. So I'm going to look at the step number 1. Your step number 1 would be to see, is the transaction at market terms or is the transaction at off market terms? So how would we realize that a transaction is at or off market terms? I'll give you an example. Say, for example, as an employer, I have given a loan to the employee. So as an employer, if I've given a loan to the employee, I tell him that, okay, I'll give you a concession loan. The market rate of interest is, let's say, at the rate of 10%, but I tell him that I will give you a loan, let's say, at the rate of 6%. So what is my contracted rate of interest? It is supposed to be 6%. But what is the market rate of interest? It is supposed to be 10%. So if you enter into a transaction, you need to compare the contracted rate and the market rate. If you remember, so far you've not seen questions where the contracted and the market rates are clearly given. But now you're going to see questions where the details regarding the contracted and the market rate will be given in the question. So I can say, when you're looking at this comparison, is it at or off market terms? If your contracted rate is equal to the market rate, it indicates that we're working at market terms. But if your contracted rate is less than the market rate, that means you're working at less off market terms. So let me also tell you one thing, that if you are saying that the contracted rate and the market rate is same, that means, technically speaking, there cannot be a difference in a transaction value and a fair value. Because in this particular case, when you say that I will charge, let's say at 10%, so if, let's say, for example, I told somebody, I give you a loan of 100 and I'm going to charge you a 10% interest, it is 110. And if you remember earlier, I said the fair value is nothing but it is a present value. It is a present value discounted at a market rate of interest. Now remember, you are charging interest at 10%, compounding at 10. And when you calculate a fair value, you're going to discount it at 10%, which is a market rate. So if the compounding is at 10 and the discounting is also at 10, naturally, the transaction value and fair values in this case will become the same. So the moment you see that the instrument is at market terms, you will see that we're going to record the transaction at a transaction value which is as good as a fair value. There will not be a difference between the transaction value and the fair value in this particular case. Because when the transaction is at market terms, you are paying or you are receiving, let's say, a coupon rate which is 10%, and when you discount, you are going to discount at 10. So if the compounding is at 10 and the discounting is at 10, there cannot be a difference. So the moment you see that a transaction is at market terms, the transaction price, or you can say the transaction value and the fair value is same. We're done. But if you notice that the transaction is not at a fair value, not at a market terms, then in this particular case, I will go to step number 2. I will go to the step number 2. So this is like my step number 1. So don't worry, I'm also going to give you the 3-step model in this case as well. So what you need to watch out is step number 1. Is the contracted rate equal or less than the market rate? Now, if you're thinking, can the contracted rate be greater than market rate? Of course not. Why would anybody enter into a transaction at a rate which is more than the market rate? So there will be 2 situations. If you compare the CR and the MR, it's either equal. If it is equal, the transaction value and fair value is equal. But if it is less, you go to step number 2. Now, when you go to the step number 2, it says you need to determine the fair value of the instrument, and this fair value is going to be determined as per Index 113. You will determine the fair value as per Index 113. So you will just calculate a fair value in step number 2. That's it. So in step number 2, the focus is only to determine the fair value as per Index 113. And then we'll go to step 3. Then I'll go to step 3. So you need to calculate a fair value and then you go to the step number 3. So this is now the step number 3, wherein I am going to look at the source, the basis at which the fair value is computed. So I am going to identify what is the base, or you can say what is the source of calculating a fair value. Now, before I read these inputs to you, let me just take the inputs and take you to the concept of Index 113. When you consider the calculation of the fair value under Index 113, we've got 2 kinds of data. One is called an observable data and one is called an unobservable data in terms of calculating a fair value. And I'll just tell you what is the observable and the unobservable part. Like for example, if you recall, there is a concept what is called in terms of Index 113, that's called level 1, level 2 as well as a level 3 inputs. Say, for example, I made an investment in a company whose shares are quoted in the market. So I made an investment in a company whose shares are quoted in the market. So that means I can get a fair value on the basis of observable data. Because in this particular case, the price of the share is quoted in the market. So it is an observable data and it doesn't need any kind of adjustments as well. If you're making investment in a security which is quoted on the stock exchange, it's an observable data which doesn't need any kind of adjustments. So that is what we call a level 1 input. But let's say, for example, I made an investment in a company which is not quoted on the stock exchange. But I identify that a similar company is quoted on a stock exchange. So the company in which I made an investment is not quoted, but a similar company is quoted in the market. I could consider the fair value of that other similar company, identical company, and then make some adjustments to get the fair value of the investment I made. So it is not something which is directly observable, but yes, it is still indirectly observable because you are taking the observable data of another identical company which is listed. And you will make some adjustments to calculate the fair value for the company in question. So this is what is called a level 2 input. So a level 1 input is something which is directly observable and requires no kind of adjustments. But a level 2 is something which is indirectly observable and you make some adjustments to get a fair valuation. And the standard is also very clear that you can say as you move down the levels from 1 to 2 to 2 to 3, then you can say the reliability keeps on declining as well. The level 1 is more reliable in nature, the level 2 gets less reliable, and the level 3 indirectly becomes most unreliable in nature. So then what is a level 3 input? So let's continue with the same example. Let's say I made an investment in a company which is not quoted on the stock exchange. And even there is no similar company which is quoted on the stock exchange. So what I would do, I will have to basically take some assumptions and calculate a fair value, maybe on a DCF technique. Maybe using a discounted cash flow techniques, go to the valuer and he would take some kind of assumptions and on the basis of which he will calculate a fair value. And largely, since he's going to take assumptions, the data is going to be unobservable in nature. So the level 3 input is going to consider data which is unobservable in nature. So which means that when we are calculating the fair value as per step number 2, what we need to do in terms of step number 3, we need to consider where did you get the fair value data. Is it based on observable data or is it based on unobservable data? Indirectly, is it supposed to be level 1 or is it level 2 or is it level 3? So are we going to be given inputs in the question that this data is based on what? Yes, sometimes directly yes, sometimes maybe no. That we'll see later. So in this particular case, if I continue the inputs, then I go to the step number 3, wherein I see if the fair value is based on a level 1 input or a valuation technique that uses only data from observable markets. So you need to see that if your data of the calculation is based on observable data, level 1 input is directly observable. Or it says that the valuation technique uses only data from observable markets, or it is any other basis, which I would say is going to be level 3. And as I said, the reliability of a level 1 data is best, and the level 3 is the most unreliable, and level 2 gets slightly less. So the standard accordingly decided that if you are going to get a data from observable input, the difference between the fair value and the transaction value is recognized in the profit and loss, and this is technically called as a day 1 gain or loss. This is technically called a day 1 gain or loss as per Ind AS 113. That means if your fair value source of the data is observable data in nature, then in that particular case, you are going to park the entire difference in terms of P&L immediately. Whatever is the gain or loss which arises on initial recognition is going to be called as a day 1 gain or loss. And it says if it is any other basis which is unobservable data, the difference between the fair value and the transaction value is either taken as an asset if it qualifies to be, or otherwise it is amortized to the P&L. It is taken as an asset or it is amortized to the P&L. Well, it all depends upon the kind of transactions. So when the inputs are taken from unobservable data, the difference is either an asset if it qualifies to be, or it is going to be treated as a deferred expense, which is going to be amortized in the P&L over a period of time. So this will all depend upon the type of transaction we enter into, and that will decide whether it is going to be treated as an asset or it is going to be treated, you can say, as a deferred expense to be amortized to the P&L over a period of time. So this is getting technical. So this is getting very technical indeed. Can you please consolidate the inputs once again? I'll do that. Then I'll document the three-step model also to you. Let me first, I think, get the framework very clear. I'll just come out of this chart and let me just, I think, make the inputs clear. So we're looking at a simple three-step model. We're looking at simply a three-step model in terms of transaction value versus a fair value. My focus is on the financial assets. So my focus is in terms of financial assets, where I am looking at that there is a difference between a transaction value and a fair value. So what I'm going to do, first let me give you the chain of thought, then I'll document this as a complete three-step model as well. So let me first give you a basic chain of thought. So I am going to apply a simple three-step model in terms of this concept. Your first focus point in every question is going to be that you need to compare the contracted rate versus the market rate. And this will help us in deciding that the transaction is at market terms or is it off market terms. So you will see two permutation combinations in this case. When the CR is equal to MR, then in that particular case, the fair value is equal to the transaction value, transaction price. In this particular case, nothing is to be done. So when you see that the things are at a market rate of interest, my life is simple. I am simply going to record the entry bank, let's say FA debit, bank credit, same debit credit, no differences. But when you see that the CR is supposed to be less than the market rate of interest, it's time to go to the step number 2. It's time to go to the step number 2 in this particular case. I'll show you some illustrations also very soon, and then I'll map up the entire concept. This is just a chain of thought. So your first focus would be a comparison of the contracted and the market rate in order to decide that the transaction and fair values are different or not. And if you say this is the case, you need to calculate a fair value using the concept under Ind AS 113. That's it. And after you've done that, you're going to go to the step number 3 and you are going to find out the source of the data in order to calculate a fair value. And in this particular case, I would say there are two things. Either you are considering only observable data in the calculation of the fair value, or you are considering an unobservable data. If you're considering an observable data, then in that particular case, the difference between the transaction value and the fair value differences is going to be taken to the P&L. That's called a day one gain or loss, as the case may be. So if you're going to get a difference based on the fair value source is observable inputs, you will take the difference immediately in the P&L. Whatever is the difference in the entry is going to be taken in the P&L. But in this particular case, when it is unobservable data, the difference between the transaction value and the fair value depends upon the type of transaction. It depends upon the type of the transaction. And when you look at the type of the transaction, I would say that there are mainly what you're going to see 3 types of transactions. Mainly what you're going to see from the examination point of view, 3 kinds of transactions. I'll tell you those kind of transactions as well. Like for example, the parent made an investment in a subsidiary. Naturally, the tendency of the parent company in terms of making investment in the subsidiary would be that the contracted rates will be less than the market rate. If the parent is pumping in money into the subsidiary company, the tendency would be because of the related party relationship, he will pump in money at a contracted rate much lower than the market rate. So one of the kind of transactions could be that there is an investment which is made by the holding company in the subsidiary company. Now, how we're going to treat that, of course, is what we're going to see. The second kind of transactions would be with employees, where the employees are given a concession loan, in which case I know that I want to give a perquisite to my employees. So the contracted rate at which loans are given is concessional and the market rate of interest are greater. So the next kind of transactions will be loans which are given to the employees of the company. And in this particular case also, the transaction and fair value differences will arise. The other kind of situations could be that when you're dealing with your suppliers, you might give them some kind of deposits on which they may not pay you interest rates. As a security, you are going to make some deposits with them, especially when you enter into transactions with your suppliers. So when you enter into transactions with your suppliers in this particular case, you will notice in this particular case that the tendency would be that you're going to make some security deposits with them. And they will not pay you interest on those deposits. They might be interest-free deposits as well. So with the suppliers, when you give them deposits which are interest-free, this will also lead to difference in a transaction and a fair value. Now, these kind of transactions will lead to a difference in the entry, which would either be taken as an asset. Like, for example, at this stage, just to give you a broader outlook at this particular stage, if you are making an investment in the subsidiary company, in this particular case, the difference between a transaction and a fair value is going to be called as a deemed investment. Because when you are giving, let's say, a loan to the subsidiary company, then you are saying the loan is given at a reduced rate of interest. So there is indirectly a deemed capital contribution. So in this particular case, the differences will lead to a creation of an asset. But when you look at, for example, the case of an employee who is given a concession loan, in this particular case, it's a perquisite value. In this particular case, when you say it's a perquisite value, you are indirectly telling him that, I am giving you some amount of a salary, a perquisite in nature. So what I'll do in this particular case, we are going to treat this as a deferred expense. And that deferred expense is going to be expensed over the period of time. So in this particular case, we might say that, okay, this is the money which is given and let's defer it or maybe immediately expense that we'll see. And the third kind of example would be when you enter into a transaction with a supplier, it could be a case of a lease transaction. And if it is a case of a lease transaction, then the concept of Ind AS 116 would apply. And the differences in this particular case will be adjustment to the right of a use asset as well. And in this particular case, also the differences will get adjusted to the asset. And therefore, it says in the chart that this difference will be treated as an asset if it qualifies to be, which means it becomes an asset if the relevant standard allows me to create an asset. And in certain cases, it will not be eligible to treat it as an asset. So depending upon the kind of transaction, you may land up creating an asset for the difference, or you may land up creating a deferred expense, which will be amortized to the P&L over a period of time. So but then there can be numerous other kind of examples as well. Are we just going to concentrate on these three kind of transactions? Yes. So our focus would be mainly three categories of transactions from the examination point of view, that if there is a dealing between the parent and subsidiary, then what? If there is a dealing between the employer and employee, then what? If there is a dealing in terms of the supplier and the customer, then what? So in these three cases, how are we going to tackle the difference between a transaction value and a fair value? I hope, friends, I have made some sense. Now, let me just go back to the chart and correlate this. I'll document the three-step model also very soon. So let me just quickly come back on this particular chart and just let's have a little look once again, and then we can document these inputs also back to you. So we are working on a special issue number 3. We worked upon TC, we worked upon the processing fee, and we've seen the treatments in the books of issuer and the holder both. Now we're looking at the treatment in terms of difference in a transaction value and a fair value. So in this particular case, we said, what do you need to do? Financial assets are all taken at a fair value for initial recognition. So as a step number 1, you need to watch out. I'll take a very simple example immediately after this chart. So we are going to look at, first of all, in the question, CR and MR, contracted rate and a market rate. This will decide the fate of the transaction. Is it at market terms or is it off market terms? If your CR, MR is same, it's at market term. The transaction value and fair values in those cases will be 100% same. But if the transaction is at off-market term because CR is less than MR, in those particular cases, you need to consider that there is a fair value determination required. Go to the step number 2, calculate a fair value. I can even remodel this three-step model in terms of the third step being called as a type of transactions. I think let's do that. Let's remodel the step something like this. Step number 1, compare the CRMR. If the CRMR is same, then in that particular case, transaction value, fair value same. If the CRMR is different, calculate a fair value. Then go to the step number 2. Let's change it. Let's go to the step number 2 and see the source of the fair value. Is the source of the fair value supposed to be observable data? Then the difference is day 1 gain or loss taken in the P&L. If the source is unobservable data, go to step 3. And in terms of the step 3, now evaluate the kind of transactions. And when you evaluate the kind of transactions, depending upon the kind of transactions, it could qualify to be an asset. Like, for example, a transaction between parent and subsidiary. Like, for example, a transaction between a supplier and a customer. And otherwise, it is amortized to the P&L, like, for example, a concession loan to the employee. So the third step will make it as a type of transaction which will decide whether it is going to be asset or liability. Let's have a look at a sample. So before we give you a break as well, let's quickly look at a sample and then we'll give you a break and we'll start working on this. Let's have a look at the illustration number 21 in the study material. This is unit number 2. We're looking at the illustration number 21. I'm just going to read the question just to have a feel of the three-step model before we document that. It says container provides containers for use by customers for multiple purposes. The containers are returnable at the end of the contract between the containers and customer, in addition to the monthly charge. There is a security deposit that each customer makes with the containers, which is 10,000 per container, and such deposit is refundable when the contract terminates. The deposits do not carry any interest in this case. If you're giving a deposit, there should be a market rate, and in this case, the contracted rate is 0, which means it's an off-market transaction. So step number 1, the moment you see that the deposits are not going to carry any interest, it is an off-market transactions, and then you go to the step number 2 and so on. Analyze the fair value upon the initial recognition in the books of customers leasing the containers. We're looking at the accounting from the holder's point of view, who is given a deposit, not from the issuer point of view, and the market rate of interest is 7%. So you can very clearly see that the contracted rate is nil and the market rate is supposed to be 7%, which is clearly indicating that it is an off-market transaction. And once it is an off-market transaction, you need to determine a fair value. As per Index 113, which we will see, once you calculate fair value, you need to see the data is observable or unobservable, and accordingly, we'll go to the type of relationship, customer supplier, or it is employer employee, or it is parent subsidiary, and accordingly we'll treat the transaction as well. I hope the basic thought process is clear. So I think at this stage, let's give you a break, and then after the break, we are going to first document the three-step model, and then we need to do a total of, I would say, 4 questions. Because one question would be on a day 1 gain or loss, which I think came in the exams. And the other questions is the 3 questions depending upon the type of relationship. So we need to do 4 questions. One is on a day 1 gain loss, one is on a parent subsidiary, one is on an employer employee, and one is on a customer supplier relationship. So we're going to do 4 questions with a 3-step model. Aha, I love the idea. 3-step model, 4 charts, 3-step model, 4 illustrations, and that takes care of the data. So time to give you a break to relax your minds, and then we take the journey forward, friends. So let's take a break. I'll join you in another 10 to 12 minutes time. Please enjoy your break. Okay, thank you. Relaxation of mind. Now, before we proceed further, let's document the three-step model in terms of the treatment of transaction value versus a fair value. So let me first pen down the inputs to you, and then we'll start looking at the illustrations on this. So this is on the concept of, I would call it as a special issue. And we are looking at a difference between the transaction price or transaction value, whatever you call it. So whether we call it as a transaction price or a transaction value versus the concept of a fair value. So what we need to do in terms of the three-step model, we are going to first of all go to the step number 1. So what you need to watch out in the question is a comparison of a CR as well as an MR. So I would put it like this, that we need to compare CR versus MR. So I'll put it across as well, that what is that CR as well as MR. So we can say CR is supposed to be the contracted rate. This is supposed to be the contracted rate, and MR is supposed to be the market rate. So it is supposed to be a CR and MR. So once you compare the two, we're going to get two permutations combination. The CR is equal to the MR, or we can say the CR is going to be less than the MR. Now, if you say the CR is equal to the MR, then it is supposed to be at market terms. Then we can say it is supposed to be at market terms in this particular case. So in this particular case, we'll say it is at market terms. And if it is supposed to be CR less than MR, it is off market terms. So the moment you see that it is at market terms, then we are supposed to consider that transaction value is equal to the fair value. But in this particular case, what we need to do, we need to compute the fair value. We need to compute the fair value as per Index 113. So we need to calculate the fair value as per Index 113, and we will go to step number 2. So after calculating the fair value, we're going to go to the step number 2 as well. Okay, with this, we go on to the step number 2. So in terms of the step number 2, now we need to focus in terms of the source of the fair value. What is the data? So we need to locate the data used. We need to locate the data which is used for computing the fair value. So we need to consider the data which is used to computing fair value as per Index 113. And there will be two kinds of data. We can say observable or unobservable in nature. So there could be observable data, and the other one is unobservable data. So if we consider the data which is based on observable inputs, then in this particular case, we need to consider the difference between the fair value and the transaction value, I'll put it as TV, is considered as day one gain or loss, is considered as a day one gain or loss. And this day one gain or loss is immediately taken to the P&L. It is immediately taken to profit and loss account. So the moment you're going to get a day one gain or loss, we're going to put that money immediately in the P&L. But if it is unobservable data, then in that particular case, we'll go to the step number 3 to locate the kind of transaction. Right, so that was the step number 2, and then we can add the step number 3 as well. So in terms of the step number 3, now we need to see the type of transaction. So we're going to look at the type of transaction in this case. And as I said, you're going to see basically 3 kinds of transactions, in which case you will see a deferments only. So I would say the type of transactions in this case would be generally 3. Either we find out that there is a holding and subsidiary relationship. There is a transaction between holding and subsidiary, or there is a transaction between employer and employee. There is a transaction between the employer and employee, or there is a transaction between a supplier and customer. So there is going to be a transaction between a supplier and a customer. Now, depending upon the kind of transaction, if you say there is holding subsidiary, in this case, it would be generally, I would say, an asset is going to be called as a deemed investment. The difference will be treated as a deemed investment, which is treated as an asset in the books. If it is an employer-employee, then it would be treated as, you can say, an expense. It is going to be treated as an expense. And in a situation where we are considering supplier and customer, this will be considered as an asset. I'll put it as generally called ROU asset, that is right of use asset in this case. Right, so let me, I guess, take this further. Okay, so this is the inputs. Now we are ready to do some questions with you. This is my 3-step model in terms of transaction and fair value. So let's, I think, begin with now the cases with you. So let me now come to the questions in the study material based on this. I guess first we can have a look out here. I guess somebody in the morning has been calling up so many times. Indeed, when you cut the phone also, they give you calls 6-7 times. Don't understand. Somebody might be busy in the morning. Good God. Okay, so I think let's first do this particular question with you. I'm coming back to the illustration number 21. Just to have a little more details on this, let's have a look at illustration 21 again, and let's see how we are going to account for this. So let me come back to the illustration 21 to make a walkthrough in this particular case, and let's have a look. My God, the gentleman is quite great indeed. He's giving me a 10th call on this. Good God. Okay, so let's have a look at illustration number 21. It says container provides container for use by customers for multiple purposes, and the containers are returnable at the end of the service contract 3 years between containers and its customer. It says in addition to the monthly charge, there is a security deposit that each customer makes with the container per container, and such deposit is refundable when the contract terminates. The deposits do not carry any interest. Analyze the fair value upon initial recognition, and the market rate of interest is given 7%. So one thing which I clearly said earlier as well, that the CR and MR is undoubtedly different in this case, resulting in that it is an off-market transaction. The contracted rate in this case is nil, and the market rate in this case is at the rate of 7%, which means it's an off-market transactions for sure. So we need to calculate a fair value. Now, if you notice, we are nowhere given in the question that what is the fair value. Rather, he's asking us to calculate a fair value at the initial recognition. So I think let's have a look at the inputs given. It says in the above case, lessee, that is the customer leasing the container, makes an interest-free deposit which is refundable at the end of 3 years. Now, this money, if it was lent to a third party, would fetch you an interest of 7%. Therefore, to calculate a fair value, what do you need to do? You need to discount all the future cash flows, which is the only money you're going to get at the end of the third year. That's 10,000. So if we calculate a fair value in this particular case, we will consider the present value of all the future inflows. So in this particular case, we are given the fair value on the initial recognition. 10,000 is discounted at the rate of 7% at the end of 3 years. So there is a differential on day one, which is this, which means if I look at the entry, security deposit gets a debit at a fair value, which is 8163. And the outflow, which is the bank, is to the extent of 10,000. And there is a difference, which is 1837 in the entry. So if I look at this from the entry's point of view, the security deposit gets a debit, which is a financial asset at a fair value. The bank gets a credit at the, you can say, transaction value. And there is a balancing figure which appears on the debit side. So how would you treat this particular difference? All depends upon the source of the data for the fair value. Now let's see. The differential on day one shall be treated as follows. Scenario 1, if the fair valuation is using a level 1 input or other observable inputs, then it says day 1 difference is taken in the P&L. So whatever is the difference will be taken in the P&L on an immediate basis. Second scenario, if the fair valuation is using other inputs, the difference shall be taken in the profit and loss unless it meets the definition of asset or liability. And I guess in this particular case, as we've already seen, that there is a relationship of, you can say, a supplier customer, and you're taking the containers on a lease. We are going to attribute the difference as ROU asset as per Ind AS 116. Let's read. However, in case of security deposits, level 1 fair value is not available. Therefore, the fair valuation is made on unobservable inputs, and applying the scenario number 2, the difference can be taken as an asset if it meets the definition. Now, since the lessee gets to use the containers in return for making a payment that is interest-free deposit plus a monthly charge, the loss interest representing day 1 difference between the fair value and the, you can say, amount is a prepaid lease rent. But I would rather say that it is to be treated as an ROU asset and can be recognized as such. The prepaid rent, as is mentioned, ROU asset, shall be charged off to the profit and loss on a straight line manner as the depreciation as per Ind AS 16. So in this particular case, even the ROU asset is depreciated based on Ind AS 116, which is on a similar lines like Ind AS 16. So this difference in this particular case is going to be called as a right of use asset. So this is the entry which will be done at the inception, recognizing a security deposit at a fair value, recognizing the bank at a transaction value, and the difference dependent upon if it is a day 1 gain loss in the P&L, and if it is supposed to be a case of unobservable data, then the relationship is the lesser lessee, or we can say the customer supplier. So that gets adjusted in the ROU asset, which is going to enter the P&L in the form of depreciations over the later years to come. Right, so that was one illustration on this area. I guess now let's take it a little further and let's come to a little more comprehensive question now. I'll just hide the answer maybe. So let's now do a full-fledged question where I am going to give you the accounting treatment not only at the inception, but let's also look at the treatment which is going to follow for the subsequent periods as well. So let's have a look. Illustration number 25 of the unit number 2. It says A made a security deposit whose details are given. Make necessary entries for accounting for the deposit in the first year and in the last year. Assume the market rate of interest for a deposit on a similar period is 12%. Now we can very clearly see in this particular case that there is no interest which is given on this deposit. Though it is not explicitly stated, but of course we are not given any interest rate. So which means the contracted rate in this particular case is 0. And if you look at the market rate of interest, it is 12%, which implies it is an off-market transaction. So in my step number 1, it's an off-market transaction. Then we go to the step number 2. And in terms of the step 2, we calculate a fair value. Now, we need to calculate the fair value and find out the source. In this particular case, I am going to basically consider the discounted value. My fair value will be the present value of the future inflow. So there is nothing to the contrary which is given that this is supposed to be an observable data. So we are going to consider journally, mind the words journally. If you're going to consider a DCF, that is a discounted cash flows, we're going to consider the fair value as the present value of the future inflows. We're going to consider it is unobservable data. And in this particular case, any difference is to be treated as an asset or expense. Now, in this particular case, since the relationship is of a supplier and customer again, or you can say a lesser lessee again, the difference is going to be attributed as a right of use asset. So we are given the starting date of the deposit and the ending date, which is a gap of 5 years in this case. We are given the description as a lease for a period of 5 years, and this is the market rate. We're given the security deposit and the present value factor is also given. So I think let's solve this particular question. Let's see the entries at the inception. And let's also see the entries which will be done for a period of 5 years, especially the security deposit account, which is going to be a financial asset, and this will be accounted at amortized cost because this is going to be held till maturity. So let's, I think, solve this out illustration. So we're going to begin with the inputs on, first of all, calculating the fair value of this asset. So let me just also keep the question in front of me. There was a question which came in November 18 in the exam, and that particular question which came in the exam was supposed to be on the concept of a day one gain or loss. Okay, so first of all, let's make the input regarding the transaction value. So as far as the transaction value is concerned, it is the amount of deposit. And the deposit is given to us, it is to the extent of 10 lakhs. Then we calculate the fair value of the deposit as well. And the fair value is going to be the present value of this 10 lakh, which is going to be discounted at 12% for a period of 5 years. Let's see what is the fair value. The present value factor is given 567,427. So this is going to be 10 lakhs into 0.567,427. So we get the fair value of this deposit.
5,67,427.
Yes, 567,427. Thanks. And then we can get the difference as well. So let's see what is the difference between the transaction and the fair value.
4,32,573.
Wonderful indeed. So 432,573 is the difference. So let's first see the entry which will be done at the very inception. So the entry in this case is financial asset, which is a security deposit, gets a debit. This is in the books of the customer, which is the fair value 567,427. And the bank gets a credit, which is to the extent of transaction value, which is 10 lakh rupee. And the difference in this particular case is the balancing figure, which is 432,573. And this will be called as a right of use asset, which is to be depreciated over a period of time. So this is how the entry will look like at the very inception in this case. And I think worth making a mention as far as the ROU asset is concerned, that this will be depreciated. This will be depreciated over a period of 5 years. This will be depreciated over a period of 5 years, and therefore it will indirectly enter the profit and loss account as well. Now, a small little question what is coming to my mind, because sometimes people do tend to get a little confused on this area. As far as this security deposit, that is the financial asset, is concerned, are we going to record interest on this? Though we are not receiving any interest, but are we going to record interest on this money? What do you say? When you're going to consider this security deposit, are you going to consider the interest income accrued on this? Though we are not getting any interest, it is an interest-free deposit, but are we going to record any interest on the same? Though I've already answered that question indirectly. Okay, I think let me put that, yes, of course. When you're going to account for the financial asset at amortized cost accounting, we are going to follow the concept of EIR. That 12%, which is the market rate of interest, is going to act like an effective interest rate. And since you have done the discounting of the deposit at 12, now you need to go for a compounding of this. The thumb rule in terms of Indies in every standard is, whenever you're going to consider the discounting of something, you are also going to go for a compounding in the future, which is also called an unwinding of discount. So let's also have a look in terms of how the financial asset is going to look like. So let's make a ledger account for a security deposit, which is for a period of 5 years. Let's see the security deposit account as well. So indirectly, we're going to record this financial asset at an amortized cost approach, unwinding the interest income at each year. So when we made the deposit, we record this as bank. So the security deposit is 567,427. This is 567,427. Unwind the finance income at the rate of 12% on this. So let's see what is 12% on this money. $567,427, 12% would mean 68091.
Yes,
And
sir.
we get a balance CD, that's right, as a balancing figure, which becomes the opening balance next year. So let's see what is the balancing figure.
6,35,518.
Okay, sorry, 6,35,518.
518.
Okay,
Yes.
so this becomes the opening balance next year. Let's again unwind interest income at the rate of 12% on this.
So it is 76,262.
Okay, wonderful indeed. Let's take the balance CD again as a balancing figure.
So it is 71 lakh 17,080.
71 lakh. No, it would be 7 lakh, beta.
7 lakh, sorry. 7
Yeah.
lakh.
7 lakh.
11,780.
718.
80.
780.
Yes, sir.
Okay, again we calculate this as a balance BD 711,780. Unwind the finance income at 12% again.
Sir, it is 85,414. 14.
Okay. So 85,414.
Yes, sir.
You can take a balance CD, balancing figure, get the balance BD.
797,194.
797,194.
Yes, sir.
So again we unwind interest at 12% on this.
Sir, it is 95,663.
Right. We get a balance CD again as a balancing figure.
Yes, sir. 8,92,857.
Great. So now we're also going to look at the fifth year just for convenience. And if I look at the fifth year, this is the balance BD, which is 892,857. Let's not calculate the finance income, but let's calculate this as a balancing figure in the last year. So we're now going to get the refund money back. The deposit will be refunded back. So this will be bank. You get 10 lakh rupees back. Let's take the finance income as a balancing figure in the last year.
Sir, it is 1,07,143.
Let's also make a calculation. Is this coming approximately at the rate of 12%? Just take 107,143 divided by 892,857. Approximately, it should come to 12%, I guess.
Yes, sir.
Wonderful indeed. So this is how the security deposit is accounted at amortized cost accounting. So what we did in this particular case was pretty logical. The deposit is going to be received at the end of 5 years. So we took a present value discounted at 12%. So we are now compounding it, or you can say unwinding of the discount. So this is how the financial asset would look like, and the ROU asset in this particular case is going to be depreciated over the period of 5 years. Wonderful. So one case is done, the case of lessor and the lessee, or you can say supplier and the customer. Okay, let's, I think, take you further upon another permutation combination. I guess in the study, there is a concession loan question, I think, as well. Maybe, I think it was in the test your understanding. So I guess I have not incorporated that maybe. Just give me a second. Right, I think I have taken a separate question based on this. Let's have a look at this particular question. Great. This is a November 2020 examination question. So let's have a look at a November 2020 examination question which came for 12 marks. A lot of questions comes in the exam on this particular area when there is a difference in a transaction value and a fair value. So let's, I think, read this particular question and let's have a look. So let me just read the facts of the case. We are given in this case on 1st April 2020, S advanced a housing loan. So when S advanced a housing loan, for him, it is supposed to be an asset. He is supposed to be the holder. It says for 15 lakhs to one of its employees. So employees is supposed to be, we can say, the issuer for whom it is going to be a financial liability. So we need to see, accounting, of course, will be asked in the books of S. It says this is at a rate of interest 6%, which is a contracted rate, repayable in 5 equal installments, along with interest at the end of each year. Now watch this carefully. It says the loan is repayable in 5 equal annual installments plus an interest. Employee is not required to give any specific performance against this bill. The market rate of interest for a similar kind of loan in the banks is at the rate of 10%. So we can very clearly see that the contracted rate is 6 and the market rate is supposed to be 10%. So this is an employer-employee relationship and the contracted rate is not comparable to the market rate. So we can say the contracted rate is less than the market rate in this case. It is undoubtedly an off-market transaction and the relationship of employer and employee is given. The accountant of the company recognized the staff loan in the balance sheet of the company, which is equal to the amount of loan disbursed, that is 15 lakhs. He is recorded the loan as an asset in the balance sheet at the transaction value itself, and this is incorrect because we need to record the asset at a fair value. Then he says the interest income is recognized at the contracted rate in the P&L, which is 6% on 15 lakh. So this also is incorrect because we do not record the interest income in the P&L at the contracted rate, but it is to be recorded at the effective rate, which in this case is 10%. So the accounting done by the accountant is incorrect. Analyze whether the above accounting treatment done by the accountant is in compliance with Ind AS, and it says if not, of course it is not. Advise the correct treatment of the housing loan, that is one. So you need to rectify the amount of the loan and the interest and other expenses in the financial statement. Why does it say other expense? Because the difference between the contracted and the market rate is going to lead to a difference at time zero, which is going to become an other expense. In the financial statements of S Limited for the year 2021, along with the applicable workings as per relevant Ind AS, you're required to explain how the housing loan should be reflected in the Ind AS compliant balance sheet of S on 31st March 21. So quite a good question indeed. 12 markers in the exam, where we are simply first of all required to explain the examiner that this is an off-market transaction resulting in a difference between a transaction value, fair value, and how the difference is to be accounted for in the books of accounts. So let's see how do we solve this. So here again, what I am going to do, first of all, identify the difference between a transaction and a fair value, get the entry at the inception, and then we'll account for the staff loan as a financial asset. So let's see what is the transaction value. So in this particular case, the loan is to the extent of 15 lakhs. That is the transaction value. And we also need the fair value of this loan. And the fair value of this loan is the present value of all the future inflow. So we are getting a contracted rate at the rate of 6%. That's one inflow and the principal money back. So let's see what are the different inflows in this case. So we're going to get a 6% coupon rate for the next 5 years, and there is going to be a principal money as well. Okay, so I think first of all, there is one particular input which is to be watched out in this case. Is the interest figure going to be same each year, or is the interest figure going to be different each year? We are very clearly given that this loan is going to be paid in 5 equal installments along with the interest. Now, this is another place where sometimes people tend to go wrong. You know, when the question says that this is repayable in 5 equal installments along with the interest, this means that you are paying an equal amount of principal. Sometimes one considers that we are paying an equated annual installment. In this case, it's not an equated annual installment. In this case, it's an equated principal repayment, because it is an equal annual payments. And when it says along basically means that it is plus the interest. So which means, first of all, I need to organize that what is the interest paid each year, because I need the present value of all those interest payments, and the principal repayments are also happening each year. So let's be very careful in terms of calculating the present value. So let's see what is the present value of the future cash inflows. So we'll organize the data for a period of 5 years. So there is going to be a principal amount received, which is equated, and there is an interest which you're going to receive. So we can get the total money and then discount it. So we'll get the total money and then we'll do the discounting as well. Now, the loan is for 15 lakh rupees, and this is paid in 5 equal installments. That means every year you are getting in principal of 3 lakhs back. So 3 lakh is the principal money which we are getting at the end of each year. Now, as far as the interest is concerned, the interest for the first year is on the outstanding principal of 15 lakh. Then it'll be on 12, then it'll be on 9, and then it'll be on 6, and so on. So let's see what is the interest at the rate of 6% on the outstanding balance. So first year, of course, it is 6% on 15 lakhs. That works out at 90. And I think the easy way is that you can keep reducing this by 1/5. Because if the principal repayment is taking place 1/5 each year, you can conveniently reduce the interest also 1/5. So if I take 1/5 reduction each year, reduce it by 18, it becomes 72. Reduce it by 18, it becomes 54. Then it becomes 36, and then it becomes 18. So these are all the future inflows which you are going to get as an employer, equated principal repayment for the next 5 years, and the interest on the outstanding balance. So this works out at 3,90,000. This is going to be 372, and this is 354, and this is 336, and this is 3,18,000. And now we need to also consider a discounting of this, and the discounting is going to be done at the market rate. I guess the market rate in this case is given to me at the rate of 12%, 10%. So let's do the discounting of this at 10% itself. So 390, let's see what is the discounting rates at 10%. So 372, 354, this is 336, and this is 3,18,000. So let's see what are the present value factors at the rate of 10% for each of these years.
Sir, it is 0.909.
Great. And 0.826, I think.
Yes, sir.
751,
Yes, sir.
683,
Yes, sir.
621. It must be
Yes,
one thing,
sir.
I've done it so many times.
Yes, sir.
I remember the discounting rates also very well indeed.
Sir, actually 10% का याद हो ही चुका है.
Yes, of course. Everybody remembers it very clear, 0.909, 0.826. Intermediate days, so much of financial management, and in financial reporting and in advanced financial management, you remember 10% directly.
Yes, sir.
Okay, so let's see what is the present value of all these inflows as well. So that's, I think, the main calculations to be done now in this case, that we need to calculate the present value of all these future inflows, principal, and the interest repayments. The first one is 354,510, 307,272. Then this is 265,854. This is last one is 197,478.
The second last is 229,488.
Okay, 229,488. Now we need to add up all these as well. I guess it is coming to 13,54,602 if I am correct. So this is working out at 13,54,602 is the present value. So this is the fair value, which is 13,54,602. Just see whether is this correct. So that gives me the fair
Yes,
value,
sir,
and we
correct.
can now correct. Okay, so let's also get the difference between the two. So that difference is the perquisite value as well.
Sir, it is 1,45,398.
Right, 145398 is the difference. Now we can see the entry which will be done at the inception. So let's put the entry at the inception. So my entry at this particular stage is going to be in the books of the employer, of course. The loan, which is a financial asset, gets a debit, which will be at the fair value 1354,602. The bank in this particular case is going to get a credit, and this is going to be 15 lakhs, and the balancing figure, which is 145398, this is nothing but we can say it's an employee expense. You can say it's like a deferred expense. So I'll call this as employee benefit expense, which is going to be amortized over the next 5 years of the loan. So this is a perquisite value. So this becomes a deferred expense, which is going to be spread over a period of 5 years. Now, irrespective, we say that the employee is being asked to meet certain condition, because he said in the question itself, if I take you back, it very clearly said that employee is not required to give any specific performance. But that doesn't make a difference whether any specific performance is required or not. We will take this expense, which is a perquisite value, and spread it over a period of 5 years. Do you want me to make the ledger account of this loan, or I think it should be manageable? To me, I think should be manageable, right?
Yes, sir.
Something similar. Yes. So I think I'm not taking this question further. This is how the financial asset is derived. Then you start making it at amortized cost accounting, and the employee staff cost is going to be spread over the period of 5 years. So we've seen two cases so far. Number one, we've seen the case of a supplier customer. Number two, we've seen the case of an employer-employee. And the third one is a holding and a subsidiary. I think I've taken or not a question on that area, because that's more at the back of this. So maybe I can directly give you the entry if the question is not there. I am afraid I think that question is not in the part of the illustrations, I guess. It is there in the test your understanding. So once you do the questions which are given at the end, there is a particular question which is talking about the holding subsidy relationship. So I think what I'll do, I'll just quickly give you the entry in that case. So let me just come back to the chart where I gave you a 3-step model, and we can just add an entry at this stage. So let me just add a journal entry at this particular stage in each of the case. I've done the employer-employee, I've done the supplier-customer. There is an illustration at the end of the study mat which is talking about a holding subsidiary, where if I remember, there is a case of investment made in the subsidiary, which is practically at a 0% dividend rate. So a difference which is coming in that particular investment is going to be treated as a deemed capital contribution. So I'll just give you the entry which will be done at the inception in this case. So in this particular case, what we'll do, let's say you made an investment in the subsidiary. So there is an investment in the subsidiary company, and this is going to be recorded at a fair value. And we will record the bank as a credit. The bank is going to be given a credit, which is going to be a transaction value. And in this particular case, we will record a difference. We will record a difference out here, and the difference, that is a balancing figure, is going to be called as a deemed capital contribution. Is going to be called as a deemed capital contribution in this case. So this will be treated as an asset in the books of the parent company. So this is how it will look like. Similarly, let's also put the entry here as well. So here what we're going to do, we will record the loan as a debit, which is going to be recorded at a fair value. The bank is going to be given a credit, which will be at the transaction value. And there will be a balancing figure which is going to come out here. And the balancing figure out here in this case will be the employee benefit expense. which will be spread over the life of the loan. And similarly, we can also have a look at the third case. So we're going to put the entry security deposit gets a debit. The security deposit in this case gets a debit and the bank gets a credit. This will be at the fair value and this will be at the transaction value. And the difference in this entry is going to be an ROU asset. So the difference in this entry, the balancing figure, is going to be called as a right of use asset, which will be depreciated over a period of time. So this takes care of the three illustrations which I made a mention, that if you're looking at unobservable data in terms of calculating the fair value, depending upon the kind of relationship, is it a parent subsidiary, is it employer-employee, or is it a supplier-customer, you are going to treat the difference between the fair value and the transaction value in each of the cases separately. So you can keep the focus in mind that when it is a parent subsidiary relationship, the difference is a deemed capital contribution. When it is an employer-employee relationship, it's an employee benefit expense. When it is a supplier-customer relationship, it becomes a right of use asset. This is not an exhaustive list of transactions where the differences can arise, but I think if you look at the transactions in the study material, the main focus is being on these three kind of relationship. So as I said, it's not exhaustive, but I think from the examination point of view, it's a safe, kind of list where you can see mainly three kind of transactions coming in. So when you see these kind of relationship, I would say it is also indirectly hinting that this is all the data based on unobservable input. Now there is another fourth illustration as well, which I'll just give you. This is a question which came in November 18. That was a case where it was a case of a day one gain or loss. So I'll just give you the facts of the case and tell you that how the difference was treated as a day one gain or loss. So it takes care of the three illustrations which I said. And now I'm looking at the fourth illustration where the fair value is based on an observable input. So let me just add another question at this stage. So I've not put that question out here, but I'm just going to add that details to you. It's a November 18 examination question. There is a November 18 examination question. I'll just give you the facts of the case. It was just a 4-marker examination question where the details were given. And after reading the details, we get an insight that it is a case where the fair value is on observable data. Let's give you the main facts. It says N granted a loan to O. So we were given the main facts that there is a company N Limited and it granted a loan. It granted a loan to O Limited. So this one basic fact. And this loan is for 120 lakhs. And this loan was given at a contracted rate, which is 10%. The contracted rate in this case was supposed to be 10%. And then it says, which is a treasury bond yield of equivalent maturity. This 10%, which was a contracted rate, is supposed to be based on, it says, at a treasury bond YTM. So this was based on a yield to maturity available for a treasury bond. I think that is a little hint that if this is the contracted rate which is based on a yield to maturity of a treasury bond, that means there is some kind of an observable data. Then he says, but the incremental borrowing rate is 12%. So we are given that as far as the incremental borrowing rate is concerned, it is supposed to be 12%. Now, I would say in this particular question, since the focus was given that the contracted rate is based on a YTM and the incremental borrowing rate means that on a similar kind of transaction, if you would have entered into a particular rate of interest, it would have been at the rate of 12%. So in this particular case, if you're looking at identical transactions, mind the word, If you're looking at identical transactions, it is indicative that there is supposed to be observable data. So this particular input in the question was indicative that the rate which is given, the market rate which is given, is based on observable input. I'll put it again. When the question says that the incremental borrowing rate is 12%, incremental borrowing rate means on a similar kind of transactions, on an identical kind of transaction. So in this particular case, this was indicating that this data is coming from observable data. If this is coming from observable data, then any difference in the transaction value and the fair value in this particular case is going to be put in the P&L immediately as a day one gain or loss. Then he says nothing else further. I am just given, okay, it says in this case the loan is granted at below market rate of interest. Ind AS 109 requires the asset liability to be taken at a fair value. Should the transaction be treated at a fair value? If not, what is the fair value and what is the accounting treatment for the difference in the transaction price and the fair value in the books of N? So in this particular case, let's see the treatment in the books of N. So in the books of N, first of all, let's find out what is the difference between a transaction value and a fair value. So let's see what is the transaction value. So the transaction price or the transaction value in this case is 120 lakhs. And we're also going to consider what is the fair value. And the fair value, of course, is based on the present value of all the future inflows over a period of time. So we are going to get a 10% interest. So we will take the present value of the future cash inflow. So a 10% interest would mean 12 lakhs. And this will be discounted at 12%. So let's see what is the factor at 12%, 5 years. The period of the loan, I guess, is given to be 5 years. So let me also mention that the period of the loan is a period of 5 years. So let's see at 12%, what is the cumulative factor? Is it coming to 3.605?
Yes, sir.
Wonderful. And then you also get that 120 lakhs principal money back at the end of the 5th year. I think that's 0.567 if I'm right. So let's take the present value of this 68.04. Is it 1113? 1113.3 lakhs is the fair value, I guess.
Yes, sir.
So we can now, is this correct, right?
Yes, sir, clear.
Wonderful. So we get the difference in this particular case, and the difference in this case is to the tune of 8.7 lakhs. Now, in this particular case, since it was a case of observable inputs, so my entry on day one will take a hit in the P&L. So let's see the entry also in the books of N. So let's have a look at the journal entry, which we are going to pass in the books of N. So he will put the entry loan that is a financial asset gets a debit. And this is to the tune of 1,111.3 lakhs. And we are going to record the outflow that is bank, which is to the extent of 120 lakhs. So the balancing figure in this case, which is 8.7 lakhs, this is going to be debited in the profit and loss account, which I said earlier is called a day one gain or loss. In terms of Ind AS 113, this is called a day one gain or loss, which is arising on account of fair value and a transaction value difference. So now if you see, we've covered all the 4 cases with you. I have covered the case of the difference arising on observable inputs, which is taken in the P&L. I've taken the transactions and fair value differences for 3 kinds of relationship: parent subsidiary, employer employee, and a supplier customer. So this takes care of my entire financial asset accounting. The special issue with reference to TC, done. The special reference with reference to processing fee, done. The special reference to the transaction and a fair value differences, done. So we are done with now financial assets accounting. Now what? The next agenda of discussion is coming back to the issuer perspective, and you need to now see how the accounting of financial liability is done. Now you would say, sir, accounting financial liability is going to be baby stuff. Because when you're looking at the accounting of financial liability, you already said that there are two categories in terms of FL. One is AC and one is FVTPL. Yes, to begin with, yes. But you know what? In terms of financial liabilities, we have got various categories of financial liability. I'm just going to spend another 2 minutes disturbing your mind so that we get a chain of thought to work on in the next session with you, because I think we're almost now done. So just a little few minutes to disturb your mind. I know today has not been a very difficult area. It's a lot of computation aspects and all, where we've just seen the accounting in a normal manner, but just looking at the differences to be treated how. Now, I want to take you into the chain of a financial liability. So watch this carefully. Maybe what I am going to show you right now, you may not be able to appreciate and understand much. No worry. The idea is only to put something at the back of the mind so that when we meet in the next class, you've got your chain of thoughts clear. So let me just come back on the study material where the kinds of financial liabilities have been expressed. I'll just make a quick chain and we'll do the discussions in the next class, no worry. Now have a look, friends, very carefully. Rather, let me just crop this up so that we can see this better. So let's have a look at now the financial liabilities. We're just having a small little introduction to the concept of financial liability without taking you any deeper in this case. Now see what it says on the types of financial liability. One is measured at amortized cost that I've already given you. And one is measured at a fair value through profit and loss account that is called FVTPL. So in this particular case, he's given you two segregations as well. I am not interested in looking at the segregation at the moment. We'll have a look. But he's telling you which liabilities are going to be taken at FVTPL. We'll see that later. Then can you see it is designated at a fair value through P&L. Now I want to make one point at this stage. There is a liability which is taken at FVTPL. And there is a liability which is designated at FVTPL. And in this particular case, there is going to be a difference in the accounting treatment. Hear me again. If you've got a financial liability which is measured at FVTPL, and if you've got a financial liability originally at AC but designated at FVTPL, the accounting treatment is going to be different. Though we do not have any such illustration, but conceptually we need to know that what is the difference in the accounting treatment for liabilities which are originally classified at AC, but then they are designated at FVTPL. So that's another category. So we are going to call this as a separate category, and this is a separate category, one which is auto FVTPL and one is which is designated at FVTPL. And then it says other specific measurement bases. Now let's have a look further out here. So when it says others, we want to have a look at what kind of other liabilities we are looking at. It says financial liabilities that arise when a transfer of a financial asset does not qualify for derecognition or when the continuing involvement approach applies. Oh my God. He's giving some technical language that financial liabilities which arise when a financial asset is not qualifying for derecognition or there is a continuing involvement approach. This is what we're going to learn when we come to the concept of derecognition of financial assets. Sometimes when you remove the financial asset from the books of accounts, The removal of financial assets from the books of accounts may not lead to a removal of a financial asset, but will lead to a creation of a financial liability. Don't get worried. So I'm saying sometimes when you are trying to remove the financial asset from the books of accounts, the financial asset doesn't get removed, but instead a financial liability gets created. That is like a fourth category. And then it says that there is a financial guarantee contracts. So in nutshell, let me tell you that we are focusing on 5 categories of financial liability. We're looking at financial liabilities at ICAI. We're looking at financial liabilities at FVTPL. We're looking at financial liability designated at FVTPL. We're looking at financial guarantees, and we're also looking at the financial liabilities which arise when the financial asset is not eligible for derecognition. Sir, what are you saying? We only got the inputs that there are 5 kinds of liability. Don't get worried on that. We will be working on these 5 kinds of liabilities in the next class. My focus in terms of financial assets is done. Now I'm going to focus in terms of financial liabilities. We need to see the accounting of these financial liability. In fact, on this financial guarantee, there was a question which is also, came in one of the revisionary test papers. I think it came once or twice, what I remember. And it's a very interesting area to watch how the accounting of financial guarantees is done. Because earlier, when you were there in intermediate, financial guarantees were accounted as contingent liability and reflected as notes to accounts. But under Ind AS, the financial guarantees are going to be recorded as balance sheet actual liability items. Let that be. So we'll take the discussions forward, friends, in the next class with you. My financial assets journey over. So next class, we're going to start our inputs on financial liability. So that's all for the day, unless you've got any questions coming to your mind. Otherwise, I think that's all for the day.
सर आपने जो अभी पहले क्वेश्चन किया डे 1 प्रॉफिट एंड लॉस से रिलेटेड, उसमें जो हम P&L में लेकर जाते तो उसमें हेड यानी क्या देंगे उसका नाम? जैसे कि हमने एम्प्लॉय एक्सपेंसेस नेम दिया और
Okay.
हाँ,
It will be definitely called as a day 1 gain loss. So that people know in the financials that this is the amount which is supposed to be arising out of observable inputs.
ओके सर,
Yeah.
थैंक यू सर.
You're welcome, Beta. Right, friends, I think that seems to be all, I guess. Right. So I think that's all for the day, friends. So see you in the next class. Keep revising. Bye-bye and take care.
थैंक यू सर.
Thank you, Beta. Anji, thank you. Thank you.